Somebody lost $8,000. Not at a casino. Not in crypto. Not even in the stock market, really. They lost it waiting for a withdrawal from a prop trading firm run by a 23-year-old from San Francisco with a Bugatti and a YouTube channel. The 23-year-old's name is Tyler Riches. Yes, his last name is literally Riches. No, we're not going to talk about that. We're going to talk about everything else. Okay, we're going to talk about it a little. Let's rewind. Tyler Riches, known online as TJR, is a day trader, educator, and full-time content creator who built one of the most recognizable brands in retail trading. Over 1 million YouTube subscribers. Thousands of paying Discord members. A free bootcamp with 56 lessons. Over 1,000 educational videos. He broadcasts live from Miami, shows real trades, takes real losses on stream. In a space full of fake screenshots and rented Ferraris, TJR made transparency the brand. And it worked. Extremely well. Almost suspiciously well, if you are the type of person who enjoys asking follow-up questions. Which we are. So. Churn's origin story. He was broke. He was in debt. He was delivering food. Then he, and I am quoting the general vibe here, reprogrammed his mind, and now he trades for a living and has 1 million subscribers. Classic hero's journey. Humble beginnings, discipline, profit. One small detail. Public non-profit tax filings, which are just sitting there on a government database available to anyone with a browser and mild curiosity, show that Tyler's father, Scott Riches, was president of a private school in Los Altos, California, with annual compensation listed at over $500,000. Other family members also appear in those filings with, let's call them, substantial salaries. To be very clear, having a wealthy family is not a crime. It is, however, a somewhat significant narrative gap when your entire personal brand is built on the premise of coming from nothing. The broke food delivery guy origin story and the $500,000 private school president dad origin story are two ships that do not meet in the night. Anyway. The actual business. Because here is the thing about TJR that gets lost in the prop firm discourse, the media company he built is legitimately interesting from a business infrastructure standpoint. Think about it as a SaaS funnel, because that is exactly what it is. Free content on YouTube, TikTok, Instagram. Massive top of funnel. That is your user acquisition layer. Then a paid Discord membership at around $150 a month. Recurring revenue. Community retention. That is your subscription product. Then custom trading indicators sold as bundles. Proprietary tooling built on TradingView. That is your premium tier upsell. And then affiliate links in every video description, promoting platforms, crypto exchanges, prop firms, all with high commission structures and zero hard cap on upside. That is a 4-layer monetization stack. For a 23-year-old who started a YouTube channel. Whether or not he can actually trade, which is a conversation the internet has had loudly and repeatedly, is almost beside the point from a pure R scaling perspective. The content machine worked. And content machines that work print money before you even think about what you are selling. His trading methodology is called Smart Money Concepts, or SMC. The idea is that institutional investors, the big banks, the hedge funds, the people with actual capital, move the market in predictable ways if you know how to read the signs. Order blocks. Liquidity zones. Fair value gaps. It sounds like you are describing a heist. Professionally, SMC is controversial. A lot of serious traders describe it as rebranded support and resistance with better aesthetics. But aesthetics matter when you are selling education to retail traders on YouTube. It is very easy to make a chart look mystical if you add enough color-coded boxes. Okay, the prop firm. This is where things get genuinely chaotic. TJR launched one-of-one funding. The headline feature, 100% profit split to the trader. Let's just sit with that for a second. 100%. If you win, you keep everything. If that is true, the firm keeps nothing from profitable traders. Which means their only revenue is from evaluation fees paid by people trying to get funded. Which means they make money when you fail the evaluation. Which means the business model only works if most people fail. Which means offering the most generous split in the industry is also the most efficient way to attract a very large volume of people to fail. That is either genius or something else. Possibly both. Early reviews were enthusiastic. The community was buying in. Churn's distribution made one funding one of the fastest growing prop firms in the retail space almost immediately. And then, sometime around mid-2024, the payout stopped. Or they did not stop exactly. They just sort of did not happen. Traders who had completed evaluations, passed the funded stages, hit their targets, were submitting withdrawal requests and hearing nothing back. Support tickets going unanswered for weeks. Then months. The platform migrated between trading interfaces, from MT5 to MatchTrader and back, and accounts were getting scrambled in the transition. One reviewer described waiting since April 2024 for money they had legitimately earned. Another tried to withdraw $8,000 and was told, after the fact, that their account no longer qualified under new rules that had apparently not been announced to anyone. A consistency rule that had previously been listed at 0.5% was allegedly revised to 0.1% mid-game. That is like if your employer changed your commission structure after you closed the deal, using a policy that did not exist when you made the sale. People started talking about it online. In TJR's community spaces, those conversations were reportedly met with bans and deleted comments. Which, to be fair, is a completely normal thing a legitimate business does when customers raise concerns. And then one funding closed. Churn's response was to create some distance between himself and the operational failures of the firm, suggesting he had not been fully aware of how things were being run internally. Some people found that believable. Others found it difficult to reconcile with the fact that it was his name on the logo, his face in the marketing, and his community that got sent there. To be fair to TJR, he was not alone in this. The prop firm industry in 2024 was collapsing industry-wide. Over 50 retail prop firms shut down within a single year. My Forex funds got frozen by regulators in the US and Canada, and it triggered a cascade. True Forex funds, Surge Trader, Funded Friends, Smart Prop Trader. One after another. The business model that most of these firms were running was always structurally fragile. Evaluation fee revenue has to exceed payout volume or the whole thing stops working. When markets got harder and more traders passed evaluations, the math broke. One funding was one firm in a very long list of firms that found out what happens when the math breaks. The difference was just the size of the audience watching when it happened. So what did TJR actually build? Because this is the part the discourse misses. The media company, separate from the prop firm, is a genuinely functional enterprise. Subscription revenue from a Discord community. Recurring income from indicator bundles. Affiliate commissions from fintech partnerships. Ad revenue from a channel with a 9-figure view count. That is an R-positive business by most definitions. The automation workflows behind that operation, the content scheduling, the community management, the affiliate tracking, the subscription billing infrastructure, these are the same logistical operations you would find in any mid-sized digital media SaaS company. TJR LLC was not a guy with a camera. It was a content business with a distribution moat, built by someone who understood the YouTube algorithm as enterprise infrastructure before he understood how a prop firm balance sheet works. The algorithm rewards consistency. And TJR was relentlessly, almost aggressively consistent. Daily live streams. Daily content. Daily community interaction. The YouTube recommendation engine is its own B2B SaaS product, and TJR treated it that way. He just also tried to launch a financial institution without the financial institution part. And here is the broader pattern, because TJR is not an anomaly, he is a case study. The retail trading influencer space has become its own ecosystem with its own business infrastructure. You do not need to be a profitable trader to make money talking about trading. You need views. You need subscribers. You need community members paying $150 a month to feel like they have an edge. The actual trading P&L is almost incidental to the media business model. In fact, from a pure retention standpoint, the ideal subscriber is someone who is perpetually almost profitable. Engaged enough to keep paying. Not successful enough to graduate out of needing the content. That is not a conspiracy theory. That is just what the incentive structure looks like when you map it out. The prop firm evaluation fee model is the same concept taken one step further. It is recurring revenue dressed up as a meritocracy. The more times you fail, the more fees the firm collects. If you pass and withdraw, they pay out. If you do not, they keep your evaluation fee and you probably buy another one because you are convinced you almost had it. This entire system, the influencer brand, the subscription Discord, the prop firm, the affiliate commissions, is sophisticated business infrastructure wrapped around a retail audience that mostly just wants to stop going to work. Which is extremely relatable, honestly. Tyler Richards, last name still Richards, is 23. His channel still exists. His community still posts. Some traders got paid. Others spent 2024 refreshing their email. What he built before it partially collapsed was a real study in how social media can function as enterprise architecture. How a content strategy executed with algorithmic precision can generate R that would make a seed-stage SaaS founder cry. And how that same audience becomes a liability when the financial product attached to it fails to function. The algorithm does not audit your payout history. It just rewards engagement. And TJR had that. The uncomfortable conclusion of this entire story is that in an ecosystem built on the promise of financial freedom, the most reliable path to financial freedom is usually selling the concept of financial freedom. The subscription product, the indicators, the evaluation fees, the affiliate links. That is where the money is. The actual market is just the set piece. Tyler figured that out early. What he did not figure out is apparently how to run a prop firm. But in his defense, neither did 50 other people that year. Anyways, thanks for sticking around. If you like this video, prepare for many more analyses of the successes and failures of all the biggest names and their business models. See you next time, ciao.